Hello, my name is Crawford Anderson. This is my Introduction to Corporate Growth, a Business 110 Introduction to Business project. Um, so, the first question is, why would a company want to grow in the first place? Expansion is fundamental for any business. There are several motivations behind pursuing growth. It's linked to profitability, as larger companies typically generate more revenue and thus more profits. Secondly, in a thriving economy, if a company is not growing and it is not keeping up with inflation in the overall economy and its peers, it's actually going to be receding. If one company is increasing by 5% profit a year and another company is increasing and not decreasing, it's not increasing or decreasing, it'll actually be decreasing by 5% because its peers are increasing by 5% and it's not increasing by a comparable amount. And thirdly, businesses' growth serves as a mechanism through which certain executives enhance their influence, prestige, and standing. It's funny because most executives, they want to see their company grow. They want to see their building get bigger, and they want to see their headquarters go from small town to big city and grow and have more prestige and awareness of their brand. The types of growth, the first type is internal. The majority of corporations achieve expansion by scaling up their existing operations. Some choose to introduce and sell new yet related products, while others extend the reach of their current products into new geographical markets or tap into new consumer segments within the markets they already serve. When growth is internally driven, particularly when it is carefully planned and managed, it tends to have limited adverse impact on the firm. If a company uses their own financing and their own capital to increase their earnings, then that'll be much more pure profits and they'll make more money in the long run than having to pay back investors or shareholders or pay off their debt, which they'd have to pay interest on. And they wouldn't be able to keep as much profits as they would be able to if they didn't take on that debt burden by trying to expand too quickly. And as well as that, if a company takes on too much debt too quickly, they can collapse. There can be some real corrosion on their business if the debt and interest payments and repayments become too much of a burden on their balance sheet. Mergers and acquisitions, M&A, is another method for a company to expand. It involves the acquisition of another firm. When those two corporations join together, they become like one union, one business coming together. It can be a company, a bigger company taking on a smaller company, two similar sized companies merging together, or even a small company taking on a bigger company, which would be unusual, but has happened. And while the majority of mergers and acquisitions proceed amicably and peacefully, because there's usually shared benefit between the two corporations, sometimes they can happen hostilely, and it would not be peaceful. It would be a hostile takeover where the leadership and the board of directors of the targeted company do not endorse the merger. But regardless of their nature, mergers are typically categorized as horizontal, vertical, or conglomerate. And speaking of horizontal mergers, a horizontal merger involves the consolidation of companies that produce and offer similar products or services in closely aligned markets. This kind of merger often leads to a decrease in the number of companies operating in a particular industry, potentially resulting in reduced competition. That regulatory bodies sometimes step in when that kind of thing happens because that would decrease competition. I mean, think about Spectrum Wireless buying AT&T or vice versa. That would leave the customer with very few options for their wireless service or their Wi-Fi service, and thus whatever resulting company came from that would have the opportunity to become a monopoly and raise their prices without too much competition. That's why the Bell company had to break off into all those little baby bells and have Southwest as one of their companies because they would just had so much of a monopoly back in the 80s and 90s and whatnot. They could just raise their prices however much they wanted because there was no competitor. Vertical mergers are another kind of acquisition and merger and way companies can grow. It involves companies functioning at distinct yet interconnected stages within the production and marketing of a product. Think a shipping company buying, or a company that produces a product buying the company that ships their product, or a producer of a good or a service buying the raw materials of that. So think about like Ford buying the minerals that go into their cars, or a mine, or even the trucking company that ships their cars. That would be kind of the vertical merger. It's when one company that's up market buys another company that's down market. And then there's conglomerate mergers. A conglomerate merger refers to a merger that falls outside the categories of horizontal or vertical mergers. Typically, it involves the fusion of firms from different industries or firms operating in distinct geographical regions. Some big examples of that are a lot of the Berkshire Hathaway mergers, or for example, when Berkshire Hathaway merged with there's a lot of companies they've merged with, but railroad companies, industrial companies, and they're an insurance company. So when they merge with something, if they're in insurance and they merge into with a company that's focused on logistics and railroads, that is definitely out of their purview, and that would be a conglomerate merger because that's something outside of their industry, and that would give them a completely new range of consumers to solicit their services and products to. Corporate growth, and there's economies to scale, market expansion, market penetration. Bigger companies have more access to consumers. They can sell, they can cross-sell more. Think about a bank that has consumer lending. They can also offer consumer retirement planning or accounting services. There's a wide range of services that a company can provide if they get bigger and have more consumers and a bigger base of customers, which they can draw profits from and squeeze more profits out of, as well as just cutting prices. If it's a much bigger company, a trucking company, if they have 10 times as many trucks, they can save a little bit of money on gas or logistics hubs or anything like that. And in conclusion, corporate growth offers numerous advantages to companies. It leads to increased profitability through higher sales revenue and, like I said earlier, an expanded customer base, fostering excellent financial performance. Growth provides a competitive edge, allowing companies to capture a larger market share, leading to economies of scale, enhanced bargaining power, and increased market influence. Diversification is always good, especially in a conglomerate merger, where a company might want to diversify away from one particular industry if they think that industry is not doing too well. And growing companies have much more resources for innovation and research and development, R&D, attracting and retaining top talent, which can help them further grow and internally grow after they grow into a conglomerate. Also, bigger companies have better access to capital. They can build an even more positive reputation as more customers and producers know them better, and they can foster business sustainability and benefit from, like I said earlier, economies of scale. They can lower those prices and maximize profits and simplify their business, and get rid of some unnecessary complexities and bureaucracy. And in conclusion, business growth is necessary. If a business is not growing, it is actually declining and faltering. If a business is not growing with the economy, with its peers, it is essentially a failing business that will not continue to exist at some point in the future.